the highway, won't you lend me your name?
Hi, it is 5 p.m. on February 11, 2013, and we welcome you to this webinar, The Physician's Guide to the 2013 Tax Laws. And this is Alan Gassman here speaking, and I want to thank all of you for attending, and also I want to thank all of our staff and team for helping me put these materials together. If you have any questions whatsoever, you can email them to me at agassman@gassmanpa.com, and we will answer your question if we know the answer, and we'll make up an answer if we don't know the answer. There's a lot of very bright people on this call today. We have, at this point, 54 attendees. I would guess that about 20% of these are physicians and physician spouses. About 40% is CPAs, and the rest is lawyers and other people who advise physicians. And my hats are off to everybody who helps take care of physicians, because we have to take care of physicians so that physicians can take care of us. Now, you can just follow along here on the screen, and there will be a replay of this tomorrow available. If you want us to send it to anybody or to send it to you, just let us know. We might even post it to YouTube. Also, there's a replay available of a webinar we gave last Tuesday called Estate Planning for 2013 Beyond the Obvious. That is another 1/2 hour webinar. It covered a few of the things we're going to talk about today and gave more detail in the estate and the estate tax area. So we commend it to you. I think it came out pretty well. If you'd like for us to send you a link, we can, or you can see at the bottom where you can find that. A little bit more advertising here. Tuesday, February 19, Lester Perling from the Broad & Cassell Law Firm from their Fort Lauderdale office is going to talk with me about 4 hypotheticals that will demonstrate how convoluted the Florida health law is and what you can and can't do with group medical practices. And this is going to be a really good presentation, because instead of spending 4 hours reviewing the laws, we're going to hopefully spend 50 minutes and review what you can do and how to do it. Additionally, we have some books on Amazon, and we can run a special for anybody who's attended this webinar. If you send me your email address, I'll send you a promotional code. The creditor protection for Florida physicians is just now being revised with the new tax laws included. The kickback and self-referral law book by Lester Perling and I. Then you have the Florida Physician Advertising Handbook, which has a lot of really neat tips from Jack Barrett, and the 2013 Guide to Prescription Controlled Substance and Pain Medicine Laws. These are all on Amazon. You can download them to your Nook, your Kindle, your iPad, or your computer through Amazon, but we can give you a promotional code if you're interested in any of these. Okay, now I just want to stress how simple and unnonsensical the tax law is. I wanted to read you one of my favorite provisions from Section 509 of the Internal Revenue Code. For purposes of paragraph 3, an organization described in paragraph 2 shall be deemed to include an organization described in section 501c4, 5, or 6, which would be described in paragraph 2 if it were an organization described in section 501c3. That's just a beautiful, beautiful phrase of clarity, and I thought you'd enjoy it. Now, getting to the new tax law, and I'm on slide 7 for those of you who might not have it in front of you. We now have a permanent new tax law, although we can't be absolutely sure whether they're going to change it further. But we have a long-term capital gains rate that went from 15% to 20%, and then for high earners, there's an extra 3.8% Medicare tax, bringing the capital gains tax rate to 23.8%. That is a big hike. Short-term capital gains are taxed like ordinary income, 39.6%, plus the Medicare tax of 3.8%. You're looking at 43.4% on a short-term capital gain. Probably best to wait the year out if you can on that. C corporation dividend income went from 15% to 20%. Thank heaven it didn't go to the 39.6% rate. Plus you have the 3.8% Medicare tax. So you're looking at a 23.8% tax on C corporation dividend income. 2 different clients have already come to me and told me that their accountants recommended that they revoke their S election so that they could receive dividends from a C corporation at the 23.8% rate. That is not the right advice, because you have to keep in mind the corporation is going to pay tax as high as 39.6%. If you're a professional service company, which physicians are, then a regular corporation that hasn't made an S election is going to pay 39.6% income on any money, and then what's left over after paying that tax is what comes out as a dividend to be taxed at 20% or 23.8%. So that dog won't hunt. Ordinary income, as you know, 39.6% plus the Medicare tax of 3.8%, 43.4%. That's a big chunk. Deductions are going to be a lot more important now. Employment taxes, the Medicare tax went from 2.9% to 3.8%. The employer still pays 1.45%, but an employee who earns more than $200,000 if you're single or $250,000 if you're married pays an additional 0.9% for 3.8% total. Now the FICA FUTA taxes went from 6.2% employer, 4.2% employee, to 6.2% employer, 6.2% employee. That's on wages up to the first $113,700. So they basically took away that 2% reduction that we had enjoyed for a period of time. Then the estate tax I'm going to get to in a little while. Now, slide 8, just to give you a little bit more substance, this is for married people. Really not much change if you make up to $223,050 and you're married. If you make between $223,000 and $450,000, then the main thing that hits you is that 3% Medicare tax. That doesn't affect your wage income because you're paying the Medicare tax on your wage income anyway. And it doesn't affect your earned active business income. It's your dividends, your interest, and a few other things we're going to talk about. And then when you hit $450,000, that's where you get that 39.6% marginal tax rate. Also, you have a phase out of certain exemptions and itemized deductions. So beginning at $300,000, your personal exemptions are phased out, and we'll go into more detail there. But basically, taxes are coming up for this person up here who's the high earner. The good news is, though, you're still the high earner. Now, if you're single with a dependent, by the way, if you're single without a dependent, call me and I'll come move in. But if you're single without a dependent, with a dependent, then you have an income at $425,000, you hit that 39.6% rate. And if you're single with or without a dependent, you hit that Medicare tax at the over $200,000. So, for example, if you earn $200,000 and then you have $1 of dividend income, then you're going to pay a tax of 3.8 cents on that $1. It's for every dollar above 200. All right, let's talk a little bit more about the 3.8% tax. I see we have a little typo here at the top of page 10. It says 2.38% Medicare tax. That's what we wish it was. It's a 3.8% Medicare tax. It's imposed on interest and dividends, net capital gains, royalty and net rental income, installment sales proceeds, even if the sale took place before this year. Even on the sale of your primary residence, you're going to pay this 3.8% tax if you're a high earner, to the extent that the income exceeds the $250,000 exclusion if you're single, or a $500,000 exclusion if you're married. Passive income from S corporations. For example, if your S corporation owns a bakery, but it also leases property, the income attributable to the bakery is not going to be subject to the Medicare tax, but the income attributable to the property rental will be. Then you have your passive activity income, like I mentioned. Then hedge fund income is going to be subject to this 3.8% tax. Sorry, Mr. Romney. Then active income from S corporations is not subject to it. Wages are not subject to it because they're getting you on the wages by payroll deduction, as we mentioned before. This is really nice. Income from your pension plan. You get a tax deduction when you put it in the pension plan, and then you don't have to pay tax when you pull it out of the pension plan. So pension plans are going to be more and more popular. Social Security income is not subject to the 3.8% tax, and municipal bond income is not subject to the 3.8% tax. So we're going to have a lot of 3.8% tax planning going in the next few years. Okay, now the deduction reductions. I'm not going to go through all of these, but one thing to mention is that your itemized deduction limitation is going to change. You're going to have a lesser ability to take itemized deductions if you're a high earner. So it's reduced by 3% of the excess over your applicable amount down to as much as 20% of the itemized deductions. So this is going to be an additional punishment, an effectively higher tax rate because of the phase out of your itemized deductions. And I have the Schedule A from the 2012 tax return on itemized deductions so you can see what the itemized deductions are. Your taxes, your medical expenses exceeding the percentage threshold, your interest expense, some charitable giving. This is going to have a real impact on high earner taxpayers, no doubt. Personal exemption, that nice little $3,800 exemption, $3,900 exemption this year, but you lose that exemption if you make more than $373,500 and you're single, or $422,500 if you're married. So I guess that's a good reason to get divorced and become single, because then if you make $373,500, you won't have any loss of your exemption. I mean, $250,000, you won't have any loss of your exemption. The alternative minimum tax exemption was stabilized in Revenue Procedure 2013-15, so that's not going to be as big a concern and cause as much interruption of you in the news when you keep hearing about it every year. They finally have that squared away, and it's going to be indexed with inflation. Student loan interest deductibility, forget it. If you earn not too much, you have a phase out of this deduction. So sorry about that. Now, how about some personal budgeting? Page 17, this is a personal budget expense spreadsheet that we put together for my household. And I can tell you, once we started keeping track, we just spent less. It was just the way it was. You get a little bit of dopamine from keeping the expenses down as opposed to a little bit of dopamine from buying something you don't need. So if you'd like, we'd be glad to send this to you as an Excel spreadsheet. But we pretty much just enumerated our expenses into categories. We also started keeping track of each child's expenses, and we shared that particular section with the child. And, you know, we really didn't have to say much other than, hey, we're keeping track of it, and every month we're taking a look at it, and I can tell you that our expenses really went down. So I highly recommend that for you. And you can, if you pay your bills on Quicken or QuickBooks, it can export directly into the Excel spreadsheet, and maybe that's a good reason for you to start using Quicken for QuickBooks. Okay, a little bit about the estate tax, and then I'm going to go back to some income tax planning techniques here. And on the estate tax, you know we had a $13,000 per year gifting ability per person. It went to $14,000 in 2013, and it's going to continue to adjust to inflation in $1,000 increments. So you can be pretty darn sure it'll be $14,000 next year and probably $15,000 the year after next if we stay at the present inflation rate. Tuition and medical expenses can continue to be paid directly. Lifetime exemption went from $1 million that you would have been able to gift above that to now $5,250,000, and it's going to go up every year with inflation. So if you or your client made a $5,120,000 gift last year, like many of our clients did in October, November, December, you now have another $130,000 that you can give this year. And next year you can expect that to be another $140,000 because it's going to go up every year with inflation at $10,000 intervals. Then the estate tax exemption, same thing. It's at $5,250,000. Estate tax rate stabilized at 40%. Now, most clients have revocable trusts, or at least most of our clients have revocable trusts, one trust for each client, And on the first death, we would like to trap up to $5,250,000 worth of assets into a trust that benefits the surviving spouse without being taxed in their estate, and then is held in separate trusts for the children on the second death. Now, the surviving spouse may have a larger exemption as this goes up with inflation. This type of trust planning is still going to be very, very important for reasons that I'm going to explain. So when you look at a physician situation, you have to take this into account. Now, if the client doesn't have nearly $5,250,000 of assets, there's still ways to get that family trust funded. It could actually be funded from assets owned by the non-physician spouse using power of appointment planning, which we are presently writing an article on. We'd be glad to share that with you. I think you're also going to start seeing some joint trusts under this new estate tax law, but I don't think those joint trusts are going to be creditor-proof like joint with tenancy by the entireties is. So be very cautious in the estate planning adjustments for physicians. Probably a lot of harm is going to be done to physicians who accidentally make changes that are not really suited for them. Also, we don't think that Congress and the President are necessarily done with estate tax planning changes. For the wealthier clients, we are working hard to try to take advantages of discounts, grantor retained annuity trusts, and defective grantor trusts, all of which are still on President Obama's hit list. So just kind of keep that in mind. We don't think that the estate tax changes are over. Okay, now we're going to go back to the income tax world here, and we're going to talk about some changes, some things to think about, just to just to go through the drill here. So what I have is an S corporation, and I would say that 85 to 90% of our clients are either in practices that have S corporations as a solo entity, or S corporations as shareholders of an LLC or partnership which has multiple S corporations. So the income from the partnership goes through to the S corporation, and then the S corporation can pay wages to the physician, which will be subject to the wage taxes, or pension contributions, or dividends, or other things. So let's talk about what these things can be. The first one I mentioned, because it's the best, is the pension plan. Now, you do have to put monies away for the other employees, or at least most of them, but a pension plan is creditor-proof. It's not subject to the Medicare tax. It's not going to be subject to the Medicare tax when you pull it out years later, when you're hopefully in a lower tax bracket, and it's tax deductible. It's the best thing you can do. We're going to have a lot of physicians with salary levels just over $250,000, because that's generally where you need to be to max out your pension planning. Next, children on the payroll. You know, what is it that Robert Heinlein said? Don't ruin your children's lives by making them easy. If you have children who are in low tax brackets, they need to learn how to work. Get them into the office, get them to learn to work from home, put them on the payroll. They will have to pay the employment tax, but they'll be in a nice low tax bracket. That money can go into a Roth IRA, and then that Roth IRA can grow tax-free for the rest of that child's life. What is that, $6,500? That's a definite great deal, especially since the 10% tax bracket is retained. So child labor, I don't think is illegal when it's your own child. Get them in there and make them work. Okay, then we have wages paid to the doctor. Now, the reason I like wages paid to the doctor is that it's creditor-proof if the doctor is the head of household. The head of household is the person who earns the most money. It's not the person who wins the most arguments. But you do have the employment tax, and for the high earners, that's more than 2.9. It's now 3.8%. So you have to balance what you pay in wages to the doctors against what you pay in dividends, because dividends are not subject to the payroll taxes, but they're usually not creditor-proof. Now, there's an exception to that, and this is more important now because of the 3.8% Medicare tax. Unlike lawyers, doctors can own their medical practice S corporations jointly as tenants by the entireties with a non-doctor spouse. And then those dividends come out to them creditor-proof against the creditors of the doctor, unless the creditor is also a creditor of the spouse. and not subject to the 3.8% Medicare tax. So we have many clients who come to us as doctors with professional associations treated as S corporations, or professional limited liability companies treated as S corporations, and we convert these to regular LLCs treated as S corporations. You have to notify Medicare of this, but it doesn't change your payments or anything. It doesn't delay your payments. And then those dividends come out, and if the doctor gets in a serious lawsuit, we don't have to worry about whether his dividend income or her dividend income would be subject to creditor claims. Now, do you put the spouse on the payroll? You need to ask your pension actuary what the impact is of putting the spouse on the payroll and how much to pay the spouse. With some types of pension plans, it can make a dramatic difference in the increase of what the spouse can get in the pension plan, and it becomes worthwhile to pay the payroll taxes. Sometimes it doesn't. Okay, then there's your rent income. Now, the rent income is tax deductible but subject to that Florida 7% sales tax. The after-tax cost of that comes to about 4.55% after you take the income tax deduction on the sales tax. But your rent income is now going to be subject to the 3.8% Medicare tax unless you do something about it. So you may want to reduce your rent. I don't think that the tax law in Florida requires the payment of rent, but most clients do pay some rent. And we're going to talk a little bit more about that in a couple of minutes, but rent is something that I think we're going to see adjusted in a lot of medical practices. And then if anyone loaned money to the practice, the company can repay that interest, and whoever gets the interest is receiving interest income, but they may be in a lower bracket. A lot of my physician clients have parents who are earning 1 and 1.5% on CDs, bond funds, and things like that. So the client borrows money from the parent, gives the parent a lien on the medical practice assets, which is a good creditor protection move, and then writes off the interest if the money borrowed is spent on investment, and the parent takes the income at the lower bracket. So that may be something worth considering. Okay, don't forget creditor protection. Everything we do with a physician impacts creditor protection. So I've got the creditor protection summary page on page 25. I'm not going to go over it now, but we've talked about wages. We've talked about IRAs and 401ks. Let me mention permanent life insurance and annuity contracts. If you invest money in a permanent life policy or an annuity contract, you don't pay tax on the growth until you pull it out. Now, with a permanent life policy, you never have to pull it out. You have the good fortune to just be able to die. And when you die, all the income within the life policy kind of disappears. Your family, if everything's structured right, gets tax-free death benefits, and that could be a good thing for a high earner. Also, annuity contracts, you can put your assets monies into a life insurance annuity contract. The carrier puts that money into a mutual fund, and you don't pay any tax till the money comes out. But let me caution you that the costs of these types of contracts can be high, and with the annuities or with a busted life policy, you end up paying all that tax money as ordinary income, not capital gains tax. And if you haven't reached age 59 when you pull income out of an annuity, there's an additional excise tax. So you're going to have a lot of people in the investment world really pushing the doctors to buy life insurance and annuities for creditor protection and income tax protection, but you really have to balance the costs and make sure that the doctor understands what it takes to keep a permanent life policy alive for his or her entire lifetime. If you pop a permanent life policy, you end up paying tax not only on the money that came out, but you can have to pay tax on the money that was used to pay premiums. So those dividends, those inside dividends that were used to pay death benefit in a permanent life policy can come out as income, and it's not a pretty sight, believe me. Okay, income tax strategies. Number one, fully fund that pension plan. And I have an employee census form that I got from Jim Foyt's over at Suncoast Pension. Thanks, Jim, for all the help you give us. You know, if you have a client who has a pension plan with a bank or with a standard brokerage firm type plan, in a lot of cases you're really doing a disservice to that client to not pull a census together and send a copy of the summary plan description and that census to a good actuary to see what can be done. I mean, these defined benefit, clone, cash balance plans, defined benefit plans, cross-tested plans. There's a lot of really neat stuff that can be done that's, quite frankly, is beyond the purview of what you get from most quote-unquote pension advisors that come out of the banking or insurance industry. So you really want to double-check that. And most good actuaries, if they know you pretty well, are not going to charge you to tell you what they can do because it's just great for their business. Second, we talked about paying children and other family members for services rendered. If it's a lot of money, then the children might establish an S corporation consulting company to render the services. So then the PA would pay benefits to the S corporation, and then the S corporation would take some of the money and pay wages to the children, but take some of the money and pay dividends to the children, especially if the children have invested in know-how, furniture, equipment, software, and things like that. That can be a good income tax saving strategy. Now, when you get into situations where you're paying an independent management company or you're paying people as independent contractors, because that's going to happen more often now than before also, because you want those independent contractors to pay their own darn 3.8% tax, you need to decide whether the IRS would consider the worker to be an employee versus an independent contractor. And we have the somewhat unreasonable IRS guidelines here in the materials for your convenience. Okay, then number 3, pay enough wages to the doctors to maximize the pension planning. 4, pay dividends not subject to the Medicare tax in an S corp. Number 5, make sure the doctor understands that if you pay too much in wages, the IRS could disallow it. Or if you don't pay enough in wages, the IRS could reclassify. Number 6, spouse on the payroll. Number 7, consider reducing rent to avoid the 3.8% tax. In some cases, we're actually going to have real estate held in the same S corp under separate subsidiary LLCs so that they're separate from income tax purposes, but this whole rent issue and the issue you get into as to whether you have enough rent income to justify depreciation and interest expense will not be a problem. Then you have the interest expense paid to third parties. You have the wages for the head of household. You have dividends paid to tenancy by the entireties. Do you have an employment agreement in place to help verify that wages are protected under Florida Statute 222? Be glad to send you our materials on that, but the short story is you really do need to have a written employment agreement in place to have a good degree of possibility that wages are going to be protected under the statute. Number 12, is it time to go ahead and have the children or entities owned by the children buy equipment or rental property, especially if you can get a great deal, and lease it to the practice so that income comes to the children under the children's brackets? Now you have the kiddie tax for where the unearned income for a child under age 25 is going to be taxed at the parent's level. I think that's ages 22 to 24 if the child's in school. So that's not a tax on cats. A lot of people think that's a kitten tax, but it's just a kiddie tax. I think they should tax cats and not children, but Congress took another approach. Now I've got a checklist here for your asset protection for the medical practice entities, things like having a lien in place, making sure you have plenty of debt to pay deductible interest, put a lien on it. Do you have a long-term lease between a related entity and the PA? Can you file a lien to protect the rent income rights to stay ahead of other creditors? There's a lot of things to think about, but when you do your planning, make sure you pay attention to that. Now, for you CPAs and lawyers, we're looking for beta testers to have free use of this software program that we've been diligently working on here, and we're calling it Estate View Planning Software. But one thing I wanted to mention is, back to the estate tax, we have something kind of nice now. It's called portability. So if a husband dies and doesn't use his entire $5,250,000 exemption, the wife gets whatever wasn't used. So if a husband dies, leaves all assets to the wife now has a $10,500,000 exemption. Now, the problem with portability, though, is while the wife's $5,250,000 allowance goes up with the Consumer Price Index, the portability allowance doesn't. Plus, there's no ability to generation skip with the portability allowance, for those of you who know what that means. So I just ran some numbers here with our new software. I took a family with a $750,000 home, $5,250,000 of investment assets, assuming that the home would grow at 3% per year, that the assets would grow at 5.5% a year after expenses, that the surviving spouse would live 30 years, and that the consumer price index would be at 2.96%. And without doing any estate planning and just relying on that portability, the estate tax on the second death, $5,840,000. Now, on the other hand, if on the first death we had put $2,625,000 in a credit shelter trust, the estate tax would only be $1,811,000. And for those of you who are advisors, what I really like about this software that we're developing is that once you get these numbers in, all you have to do is click the up and down arrow, and the number changes, and these charts automatically change, and all these numbers automatically change. So you can see the results of each change, and then, of course, you can print it and then make changes and compare them. So we're looking for beta testers. Please send me an email, and we'll be glad to send you the software for that. And please remember one of my favorite rules, Bob Burke's rule. For every complex situation, there's a simple answer, and it's usually the wrong answer. Complex problems almost always call for complex solutions. We find that very often in the physician world, and I think those of you who are listening understand and appreciate that. Like, one consideration is the minimum distribution rules for IRAs and pensions. A lot of doctors have significant IRAs and pensions and haven't thought through how those are going to be paid out on death, because you can have it go to the surviving spouse as a rollover, and then the surviving spouse can take it out over their life expectancy. And in this example, for a 75-year-old spouse, it comes out over those percentages, so it really comes out slowly for the whole life expectancy, but especially slowly the first 8 years. Or you can have it payable to a credit shelter trust, which will avoid estate tax, like I just mentioned, but then it has to come out a lot faster, as you can see there. Or you can have it go to trust for the children only if the spouse doesn't need it, and then it can come out very slowly under the minimum distribution rules. So these are the types of things that we want to talk to our clients about. Okay, one last thing, because I promised that this would be over in 30 minutes, and I'm at 33 minutes. But you might want to use this chart for your clients at page 50, just to go through what they're doing with their IRA, 401k, annuities, life insurance, wages and wage accounts, their automobile, their professional practice company, how their dividends are going to be paid, how they're going to own their building, how to set the rent, how they're going to own their securities and their real estate in a creditor-protected world, possible use of a Nevada asset protection trust if they want to make a gift to an irrevocable trust that they might actually be able to be a beneficiary of if they have a drastic change in circumstances. Lots of room for creativity. 529 plans are going to grow and not be subject to the 3.8% tax. So thanks very much for joining us. I will just turn to the end here, and there's plenty of things that you can leaf through if you want other ideas. If you'd like for us to do a longer version of this or a part 2 sometime, just let me know. If we have enough requests, we'll be glad to do it. Don't forget to take a look at our February 5th estate planning for 2013 Beyond the Obvious. We welcome Tom Ellwanger to our firm. He's really given us a lot of input on these materials. It's great to have him. Don't forget to watch Lester Tuesday, February 19, 2013. Don't forget to think about our books. And thank you for joining us. Have a fantastic afternoon. Now I'm going to open all those emails and send you some answers. And thank you so much for the opportunity to work with you and to share this information with you. Good night.